been depreciated for straight line is useful life is 10 years, it had no residual value. So what is the per year depreciation? 10,000 minus 0 divided by 10. Answer would be 1,000. So per year depreciation is 1,000, right? So year 1 depreciation, year 2 depreciation is also 1,000. This is 2011, 12, 13, again, because 13 has already passed 1,000, and 9 months. So 9-month depreciation gonna be 1,000 multiplied by 9 by 12. Answer gonna be this 750. Right? Because this 11, 12 and 13 has gone, so depreciation are already recorded over there. We are in 2014. So only the asset which stays to us only for 9 months. So this 9-month depreciation are liable that we will record it to our books of account, matching principle. Right? So that's why only 750 is here. Many questions there, many students, they will confuse, sir, this will be 3,750. No, it is only 750. Why? Because this will stay us, because whatever happened in the past will stay in the past. So we are in 2014, we will record till how much we have used the asset. So depreciation is 1,000 per year. We only use it for 9 months. So 9 months depreciation are eligible for us to record, which is 750. Depreciation entry is the same, depreciation expense to cumulative depreciation. But now we sold the asset for 7,300, right? So up till now, its depreciation is total, its book value, cost minus accumulated depreciation. Answer gonna be, but we sell it for, so we sell it for profit or loss. According to us, its value gonna be 6,250, but we sold it for 7,300. So it is a profit, but can we call this as a profit? Because this is not our normal business operation. We call this as a gain. So how much we receive the cash? Entry would be cash received. So cash to no, because we sold the asset. Asset decreases for 10,000. So cash to equipment 10,000. So, and then this is a combined entry. So we dispose of the asset. So make a reverse entry, accumulated depreciation gonna be debited. So difference is gonna be here the gain, because gain is treated as income. So income increase, which means retained earning increase. Retained earning increase means credit, right? So everybody understand this entry? Ella, Marilyn?
Yes.
Good, good, very nice. Nam, understand?
Yes.
Pinyo?
Yes.
Okay, good. So we have the example here as well. So it is just for you guys. Pause the video because we don't have much battery here left here. So I'm gonna skip in that one. So those who are watching online, please pause the video here, read this illustration and its solution as well. Okay? So I'm showing you here. Now selling a plant, simple. First of all, when you sell the plant, remember that one is up till now we have used the plant, so you will be liable to record this depreciation. if you use the plant for 2 or 3 months and after that you sell it, so 2 or 3 months depreciation you will record it. Simple. The rest of the calculations are the same. So you receive the cash. If there is a loss, you will see in this case a loss. So loss is going to be debited here, right? So just pause the video, read the whole illustration, and try to solve it by yourself, and then match the answer here. If still not understand, please do message me on my BChat group or personal message me. I will be explaining that one. Now, what happens if we exchange a plant asset? So there are two companies. We don't need this plant, but we will be exchanging the plant from them. So the fair value of those assets gonna be compared, right? So just read it here and let's read the example here. So Papa John's trade in the old automobile for a new one with a fair market value of 15,000 and pay cash 10,000, right? So which means they just gave their old automobile and a 10,000 cash, they receive a new one. The new one cost them 15,000, but they handed over old one and paid 10,000 cash and received the new one. So the new one, the old one had a cost of 9,000 and its accumulated depreciation was 8,000. The implied fair value was 5,000. How is that? Because if you go to the market and buy a new car gonna cost you 15,000. You hand it over old automobile and pay an extra pay 10,000. You receive the new automobile, right? So that's why 5,000 is here, right? So it means you sold the car in exchange for 5,000. You add that 5,000 and with your 10,000, so it's like you purchase the car for 15,000. But did you notice something here? Your book value was only 1,000. Why? Because cost was 9,000 and how much you have used? 8,000 you have used. So according to you, the value of the old car gonna be $1,000. But you exchange with the new one and pay 10,000. It means it's like this old car sold for 5,000. It looks like that, right? So it means there is a gain. Yes. When you sell the old car, there's a gain of 5,000. Right? So how we are going to treat that one? Like new car increase, new asset, right? Asset increase 15,000. Cash is paid. Cash decrease 10,000. Right? 10,000. And now let's treatment for the old car. Old car depreciation is debited 8,000 here. Right? Old car sold, decrease of old car completely 9,000. So the difference 4,000 because we still have 1,000 value. So 4,000 is our gain. The gain is recorded as credit. So treatment is the same, just the way you add flavor to the question. It can be changed, but the treatment is like the same. It is like you sell the asset on profit, on gain, right? In this case, you just exchange the asset on gain. It can be on loss as well. If there is a loss, then entry is the same, only this will come here on the debit side as a loss, because loss is treated as expense, and expense increase, debit. Simple. So if you put all these on, on T accounts, so remember that one. The gain gonna be on the credit side, loss is going to be on debit side, and this will go to income statement, right? Now, treatment for intangible asset. So first of all, let's talk about the natural resources and intangible asset. So let's just talk about first natural resources. Remember what we call that? The natural resources are not depreciated. Why? Because it has actual value. Because depreciation is non-cash expense, but in case of natural resources, we call this depletion. For example, we have a forest, we use timber, right? We have oil well, we have iron ore, we have silver mines, coal mines, right? How much we have extracted from that one? We have a freshwater well. So that the decrease in the value, we call this depletion. So it is different from depreciation, but entry is the same. Rather writing depreciation, you write depletion. Simple. And all of the stuff, become the same, but only slight difference is that because natural resources, when you extract them, your purpose is that you will sell it, like lumber or timber that you cut off from your natural resources forest, that is used for selling purposes. So the unsold material that you take out from your natural resources will become your inventory. So only just small differences here. The rest of the stuff is the same, because depletion is being accounted for just like as a depreciation. So let's talk about this illustration here. So we have oil reserve, which we purchase or which cost us for $100 million. It has capacity to provide us 10 million barrel of oil, right? We pay 100 million, and it has capacity to pay we can extract 10 million barrel of oil. So the company, so what will be the entry? Simple. So ExxonMobil is integrated oil company, meaning it both drills and refines it. So the company retains some inventory rather than selling it. Upon purchase or development of the oil reserve, what will be the entry? Entry is simple. Oil reserve to cash. That you purchased the asset increase, you pay the cash. For capacity, there is no entry for capacity. It is used for depletion purposes. Now what happened? The depletion rate is $10 per barrel. $10 per barrel. So how many barrels? It's gonna be extracting. They extracted 3 million barrel, and 1 million barrels are sold, right? 1 million barrel are sold. So what will be the entry? First of all, 3 million barrels are extracted. Depletion rate is 10. So 10 multiplied by 3 million, answer is 30 million. So here, because we extract it for selling purposes, so that our inventory increases. Asset increases for 30 million to oil reserve. Oil reserve is like a contra account, like accumulated depreciation.